Happy Thursday. Glad to be back. This is Pedro de Leon.
What's up, everybody? This is Chihiro, and we are Beyond Stocks. We want to talk to high-income earning professionals and business owners to learn about how you can improve your portfolio through investing in alts.
That's right.
Now, Pedro, you just got back from California, right?
That's right. I was going to say that. I'm glad to be back, right? I forgot I already mentioned that. But yeah, I just got back from Cali. Like I want to say that the weather is amazing. So come on, Texas. you know what I mean. So, but yeah.
Come on, man. It's only like 137 degrees out right now. It's cool.
Yeah,
dude.
it's not. That's it. Yeah, I'm scorching. Feels like the devil's like blowing on us right now. So yeah, no, absolutely, man. So yeah, it's great to be back. Take a little R&R at the same time. Catching up with things here. So exciting to discuss today's topic. So today's topic is about, let me say this again, non-markets, assets that are non-correlated, or meaning like, assets that are not correlated to the stock market, So, and this is typically assets such as real estate to oil and gas businesses or so. And so, let's get it going. Now, a lot of people have always talked about, like what can I do to start creating income outside of stocks and bonds? And was always a question that's been asked to me when I was a financial advisor. And this is what we're going to talk about. We're going to go straight to some, topics on this. Now, so what does it mean exactly, and why does it matter? So Chihiro, can you kind of chime in on that so you can take off? Yeah.
So stocks tend to be correlated to each other, which means they tend to move together. Now, that's obviously not true in any absolute sense, right? There's a tendency for stocks to move together. So when you're constructing an investment portfolio, that can be a concern, right? If everything is moving together. So the analogy I like to use is investments are elevators, and is the passengers in these elevators. And so some of these elevators are going to move up. Hopefully, very few or none of them stay stationary or go downwards. But the reality is with investments, there's risk, right? But beyond that, you also want to think about, well, how many of these elevators, how many of these investments move together? How many of them tend to go up as a group and or go down together as a group? And so when you're thinking about how to formulate your asset management, with respect to your investments, you need to think about about the correlation across these investments. So, So the idea of the concept of it is that some of these elevators are going to move up and down together. And so that's why you don't want all of your passengers in one elevator or in correlated investments.
Right. Absolutely. So, there is plenty of ways to create wealth outside of the Wall Street typical traditional investments. So, what are some of the ideas or things that for a fact that you can start creating, wealth? What's some assets?
So, let's suppose you find an ETA deal, and that's a topic that we've covered before. ETA stands for entrepreneurship through acquisition. So let's suppose I know somebody who had a significant manufacturing experience, but only in a corporate context. So he worked for companies that manufactured stuff, right? And at some point, he got tired of working for the man, and he ended up buying a factory, a family-owned business that manufactures adhesives, like a niche product. And he felt after 20 plus years of experience in manufacturing that he had what it took to buy a business, raise capital from outside people to buy that business, and then be the operator. And fortunately for him,
Mhm.
He's resourceful and intelligent, and he has done very well for himself over the past few years, expanding and improving this business. So that's an example, real life example of ETA. So
Yeah.
that's something where you can imagine the main driver of whether your investment in that deal is going to go well or not is going to be the chops of this operator, right? Whether he succeeds or fails. And that's really not going to be affected too much by what stocks are doing. So I would say that's highly correlated with the
Mhm.
market. But there's still a lot of risk, right? Because this guy needs to execute. So
Right.
in your due diligence process, you got to look at, all right, do I trust this guy's experience to be able to execute?
Right. So that brings another question is like now with alts, does it tend to be less market correlated? And does that mean they're safer?
Yeah, dude, great question. So they are less correlated, but it doesn't necessarily mean they're safer. So take an example, take that investment example where so he made a projection, a pro forma to his investors, and also offered regular dividends to his investors based on the
Mhm.
profits that he expected to generate, right? And sorry, my phone just rang.
Yeah.
But so that's not going to be correlated to the market, which is great.
Mhm.
But then uh, that just really means that he is really absorbing the ups and downs of his business. Maybe an important buyer left, or maybe an important supplier has raised its prices. All of these different things that he has to deal with as a business owner. Um, he
Right. Yeah.
absorbs that, manages the business to address those things, and through once it passes through that filter, then you're getting that 7% preferred return or whatever. So on your end as an investor, maybe it's just clockwork, 7% per year you're getting from this
Mhm.
deal. But
Right.
he is scrambling day to day running this business, right? So at the end of the day, does that mean it's less risk? Maybe.
Mhm.
It's certainly less volatility from a return standpoint
Yeah.
for you as an LP in that deal.
I like how you say that because a lot of people don't see that on, they don't dive into like what makes a company work. And at the end of the day, any company, private or public, right, it's correlated to the team, right, to to
Yeah,
the operator. But you have more of, I want to say you have a little bit more control in the sense of like having a one-on-one discussion with the operator on a private side than you do on the public side. Because you're not going to be able to
I
talk to the
agree with that.
CEO of, to with a public company. But
Right.
you do you could keep updated with what's going on with the company, and if the operator is very he's upfront with things was happening, you get your quarterly meetings. You as an investor, you can always say, hey, you know what, I might know someone that might be able to help us to get this issue solved, right? And so that's something that you as an investor have the opportunity. Now it depends, of course. If you're investing in a fund, it's a whole total different. But if you work investing with someone one on one, like I did, like Shihiro has done in the past, you can talk to the operator, one on one, and kind of give them ideas and help with that. So, um,
Yeah.
yeah.
And also the flip side of that, or another aspect of that
Mhm.
is if you pick the right jockey on a private offering like that, and that business does really well, then uh you can get really outsized returns because you are a shareholder in that guy's business, right? And you chose the right operator and he executed really well, and now you reap the benefits of that.
Yeah, yeah. So here's the other question, right? So knowing what you guys know now, right? Operator, you know, yeah, less risk as far as like working, investing in a public company. Does that mean that I have to diversify my portfolio, into different alternative investments to mitigate that risk?
Yeah, so I think everybody more or less knows, all else being equal, you want to diversify into as
Hmm.
many assets as possible. So you want to put your passengers into as elevators as possible to mitigate risk. But here's the problem with that is there's a paradox here, because some of the greatest wealth creation events in human history happened because somebody made, or a group of people made, concentrated bets, right? So, take Jeff Bezos, like the second richest man in the world, or the richest man in the world, Elon Musk. Like, he did not diversify, clearly, right? He completely concentrated all his efforts and resources into a small number of like pretty outlandish business ideas, frankly. And through sheer resolve and brilliance and ridiculous effort, he's made himself the richest man in the world. So the fact of the matter is, concentrating risk can have outsized returns more than diversifying. But for us mere mortals like you and I, who we're not, geniuses, nor do we have the capabilities and resources of an Elon Musk, then generally from an investment standpoint, diversifying is the way to go. But I'm kind of speaking out of both sides of my mouth, as I was able to generate capital through concentrated bets in multifamily, because that was my origin story as an investor, was doing multifamily deals. And that was very much concentrated risk.
Yeah. No, absolutely. So one thing that I want to bring up, I like that point as far as like Jeff Bezos and his other conglomerate individuals, billionaires. They have focus on one thing. But again, the reason they are where they at is because they actually focus on actively working in that business idea, versus as an LP, then as a limited partner, you're not technically working for that idea. You just invest in someone else's idea and let them handle that momentum and the strategy that they have to put together, and the work they have to put into that. So a lot of people will say that, and sometimes if you want to become the billionaire, you want to be the next billionaire, I mean, it just takes a lot of work, and it does not mean that you can start diversifying all your portfolios, which a lot of people have diversified portfolios and live out of their dividends. But it's definitely like with founders, they're the ones who put a lot of time and effort, work hours and hours a week just to get to the next goal, to the next level. And so, which is why a lot of people tend to go to the GP route, because they want to become the next millionaire, multimillionaire or so. So, just keep in mind where, what are your strengths and what are your weaknesses? And if you say, hey, I'm enjoying what I'm doing, I love my job, I love my business, or, I have some, money stashed somewhere, or from being a beneficiary from someone's life insurance, and they say, you know what, I just want to invest it, that's definitely, as an LP, works well for you. Now, if you want to be a GP or a founder, start it, then you can definitely do it. So
there's plenty of examples of people who were not a founder or a GP, like they were a pure investor in something, or they frankly just got lucky and became an investor in something, and it really hit right. I think of years ago, I was listening to a podcast, the Joe Rogan podcast, and he had on this guy, I believe his name is David Cho, and he's like a artist. He does murals, right? So he did a mural at the Facebook headquarters. They didn't have hardly any money at that time. Facebook didn't. So they said, hey, do you want, this cash payment, or do you want stock? And the artist said, oh, I'll take the stock. It was worth over $100 million at the time of that podcast recording. I'm sure it's more at this point, right?
Wow. Yeah.
I mean, he was decisive about it, but like he had nothing to do with being a GP or a founder or even he just elected a compensation option, and it worked out. Another story, I talked to somebody who was a founder of a business, sold that business to Apple. And this was like 20 plus years ago. And Apple said, do you want cash or do you want stock? The guy made a decision to take the stock and held it for 20 plus years. So you can guess that did pretty well, right? So now his job is not building businesses, but he has his own single family office that
Yeah.
essentially created a company whose job it is to grow that money.
Right. Yeah. Those are very rare, man.
But
those are,
it happens.
yeah, it happens. Yeah.
It happens.
Yeah.
Yeah.
Not, I
I
guess
mean,
the go now. Yeah, go ahead.
think if you happen to have the opportunity to invest in SpaceX or Tesla or any of these companies, like while it was still a private offering
Hmm.
before it was publicly traded, well, SpaceX still is private, right?
Yeah.
And you just put 50 grand into that. Think about what that's worth right now. It
Yeah.
happens, man.
Yeah, yeah, definitely. But I do want to say that this is the problem that has happened in the past couple years, that because of those opportunities like that is really rare. VCs and angel investors had invested into these like startup companies and never took off. Right. I just read recently that the VC model is changing to kind of mirror similar to the private equity model as far as like due diligence and everything. Right. So it's a hit and miss in that, and that's definitely like, whew, man, playing Russian roulette in that sense, right? You get the bullet, but it's really rare. But yeah, but man, if you guys can find something out there like that, man, definitely jump on it and get some stocks.
I mean, I get these deals, man, but yeah, just like you said, man, the odds of them hitting are so low.
Yeah.
I've invested in one VC deal to date. Um, we'll see. In hindsight, I probably wrote way too big of a check, given it's a
Mhm.
VC deal, but it is what it is. I already wrote the check, so
Yeah.
hopefully it hits, man.
I know this is off topic, guys, but the one thing that I want to bring up is that there are platforms coming up. I think it's called something studios, VC studios, or whatever, and it's an opportunity to invest in, where you're investing in a startup company or a company that has an MVP, a minimum viable product, and if the studio picks them up, the VC studio picks them up, then the VC will actually work with them on creating, the as far as the sense of the business, and invest a little bit into them to scale it. And this is how they're mitigating their risk. I just see one just open one here in Dallas. And so the old school traditional way, and any of you guys might want to correct me on this, but I know this how I've seen so far. What I've seen in the previous is that the VC will invest in a founder, but then let the founder handle everything. On the contrary, on this studio model is more like, we invest with you, we work with you, and we have a team that can help you whatever is you need help with, and we'll provide those resources. And I guess this is a way to mitigate your risk. But I know it's off topic, but yeah, just thought about that. Yeah.
So the other topic we were going to discuss, Pedro, right, was
Mhm.
you and I have both seen a lot of real estate deals come through our email inboxes. Of course, that volume has
Yeah.
dramatically reduced of late, but even
Mhm.
so, I still get them. And one thing that always kind of rubbed me the wrong way, not rubbed me the wrong way,
Mhm.
but that needs more clarification, is the purported tax benefits of investing in commercial real estate deals.
Mhm.
I think there's like a surface level assumption that this is going to be amazing from a tax standpoint, but you really need to understand what the limitations are of those tax benefits when you see commercial real estate deal come into your inbox, particularly with respect to two things that they talk about. One is called cost segregation, and the other is bonus depreciation.
Mhm.
Um, so, cost segregation, I'll start with that, is accelerated depreciation. So, if anybody buys an apartment a
Mhm.
complex today, then the depreciation period on that is 27 and a half years, meaning you can depreciate that asset roughly 1/27th or 1/28th of that purchase price on an annual basis. So
Yeah.
that depreciation ends up being a tax benefit, um, and it can offset your passive income from that deal or any other real estate deals.
Hmm.
If the operator of that deal undertakes this process called cost segregation, then you can accelerate that from 27 and a half years to much quicker, meaning you can take more depreciation annually on that asset, meaning you accelerate that depreciation so that you can get more tax benefits sooner, uh, as uh, as generated by that asset. So that's what cost segregation is. Bonus depreciation is something separate that, with this recent Trump big beautiful bill legislation, he has brought back 100% bonus depreciation. So this is really big, not only in the investing space, but even um, really any business, including small businesses that buy assets. So think of, man, like a bakery that buys baking equipment, right?
Hmm.
Or ovens
Yeah.
and stuff that can be pretty expensive, or any business that buys like the real estate that they're housed in, like the storefront or an office or whatever.
Hmm.
100% bonus depreciation can increase the depreciation that you get from that, which is a tax benefit.
Yeah.
Um, so on service, that's all great stuff, but I know you can feel there's a but coming.
No, no, actually, it was not gonna say, but, well, it's more of an addition to that. When I know you and I discussed about this before, when a company or a funder, a GP comes in and starts throwing all these like tax benefits, and it's important to ask, like, have you been working with a tax professional about this? Um, Put them, ask simple questions like that, or you make sure to ask your tax professional, like, hey, do you know anything about this, and want to make sure that I can get some the benefits what they're saying, right? So you
Yeah.
can cover
I
yourself.
will That's a very good point. I will say, from based on my experience, typically the operators uh are working with the right professionals in order to get those tax benefits to their LPs, their limited
Hmm.
partners, aka their investors. But what is more critical is the second piece of what you just said, Pedro, which is the LP's accountants very commonly don't know, they don't understand partnership accounting. They don't know how to properly account
Hmm.
for these tax benefits, and they either waste them or they
Hmm.
apply them improperly. I see and hear about that
Right.
very commonly. And our previous guest, Vince Porter, actually talked about that exact point, that
Right. Exactly.
LPs often don't have the right accountants on their teams.
Right.
Yeah.
Right. Definitely. Yeah. So here's a question that I have, right? So does that mean that, all else being equal, a real estate deal with these tax benefits is always better than an equivalent non-real estate deal? So, like, say if I want to
Yeah.
do
So,
something else, right?
um, thanks for softballing me that question, bro, because that was the butt that was coming from all these
Yeah.
supposed tax benefits, right? So the number
Yeah.
one thing is these benefits, unless you are a real estate professional, like for example, you're
Hmm.
a real estate agent or broker,
Hmm.
which most people are not, obviously, right? So
Yeah.
if you're not a real estate professional, then these tax benefits, it's not like it's going to go towards your income, your W-2 income as a finance professional or as a doctor, and you can just offset that income from all of these passive losses that you got through cost
Right.
segregation and bonus depreciation. It doesn't work that way.
Hmm.
So what you can apply those benefits towards is you can offset other passive income with those tax benefits. But if you're uh, if you're in the automotive industry, if you're in anything that doesn't qualify you as a real estate professional, then the what you can use those tax benefits on or against is highly limited. So
Yeah.
that's the number one thing that I think is glossed over when I get these emails from some multifamily syndicators saying, "Oh, you're going to have Trump just extended 100% bonus depreciation." Well, okay, that's great, but like, I'm not a real estate professional. I know most Americans are not. Most of the investors in your deal are not going to be real estate professionals, so they kind of leave out that part that yeah, that's great, but there are limitations.
Yeah.
Um, yeah,
So yeah, I learned that. I have no idea, man. And yeah, when you told me about that, I was like, that's very interesting. So
yeah.
you gotta be careful with that. So yeah, I mean, there's so many things out there that as we, especially with this new bill, there's a lot of tax opportunities. We probably can jump on it next time, but definitely give it a look. Right? You download it into ChatGPT and let them explain to you. It makes it a little bit
Yeah.
much simpler, right? So yeah, with all that being said, there's so many ways to actually create wealth outside of the Wall Street traditional investments. And we always talk about real estate because it's always the number one asset that most people jump on because it has appreciation. You can get dividends from that on the single
And
family
it's
house
the
into
most common
multifamily.
investment out there in terms of
Right.
private offerings.
Right. The most common
Yeah.
one, right? So there are other things out there that's just a little bit more niche, and it takes some time to understand it, right? Understand the economics on the micro and the macro, and then making a decision that this is going to be a valid asset to invest in. But the ETA model is also just like Shihiro mentioned earlier. It's another way to create wealth. I know some people that actually buy 2, 3 companies, and they buy it at a certain price point where they don't have to work in the business, and they hire a team, a small, very small team, 1 or 2 folks that can run it for them, and so they can build that portfolio. So there's things like that they can do, and we talked about this before in one of our previous episodes. So anything you want to share, Jiro?
Just want to share a interesting deal,
Hmm.
opportunity that came into my inbox, I think 2 days ago.
Okay.
So, it's fast food or QSR, quick service restaurant. It's a small footprint model, right? So think of like Salads to Go or Dutch Brothers. It's more almost like a kiosk more
Hmm.
than a restaurant. You know what I mean? Um, and their whole thing is it's like healthy protein bowls instead of you know your typical unhealthy stuff.
Right.
And I thought that was really interesting. So it's a franchise model. So
Hmm.
hey, if any of you, if that resonates with you, like a potential or a business opportunity in being a franchisee of a fast food model, but it's unhealthy, or excuse me, it is healthy. They talked about not having any fryers, any griddles in the kitchen of these facilities because it's all like fresh prepared stuff. So I think that'd
That's
be
very,
amazing because it's
yeah.
really hard to find healthy food in this country.
Yeah, a long time ago, I mentioned to my wife, I was like, hey, because she's a lot of gluten free stuff, and I was like, hey, maybe start like a restaurant just gluten free because there's a lot of people that cannot eat gluten, right? There's a celiac disease, there's so many issues.
Yeah.
Definitely a hit off, and I like that niche what you said. It's just no grill, nothing like that. It's just
Yeah.
natural,
So,
right?
total side note, man. So the
Yeah,
gluten-free thing, right? Really interesting because people are having all these digestive problems, but there's a
yeah,
theory. I don't know if it's gotten past the theory point yet, but like apparently in American mass-produced bread, there's all sorts of like borderline toxic things that are being put
yeah,
into them as far
yeah.
as like dough conditioners, preservatives, all these additives, right?
Hmm.
And so there's a theory that people haven't all of a sudden gotten freaking intolerant or
Sensitive.
gluten sensitive, but rather
Yeah.
it's all this other stuff that we are putting into mass produced bread that is screwing people up.
Hmm.
And it's possible that we may be villainizing gluten when it's actually some of the other stuff that we are putting into bread products.
Yeah, I do want to say you absolutely correct. And so the reason why she eats a lot of gluten-free bread is because doesn't have all this toxic stuff that's added into the bread. And we did found a location, and actually is a franchise. It's called House of Bread, and they actually make the bread there. Like they don't go and purchase somewhere else. What makes it
So
the
let me guess,
manufacturer?
she can eat regular bread as long as she buys it from that
Yeah,
place, right?
yeah, yeah, yeah,
Yeah.
yeah. So you have a point. Now
So
there are people that we do know of that test it sensitive to gluten itself,
Oh, absolutely. No,
which
celiac
they have
disease
to,
is a real thing for
yeah,
sure.
yeah. So,
Yeah.
but yeah, I mean, it's a little bit less crap on the bread, so which is why she was like, I'm just eating gluten. If I go outside to eat a restaurant, I have to be gluten stuff,
Hmm.
gluten
Oh
free,
yeah,
so yeah. But
totally,
yeah,
man.
the same thing goes with now. I did found, I don't know why I have never taken off, but there is a restaurant that's called Protein House, and apparently it's just like focus on mostly protein. So I seen this in Vegas actually a couple years ago. So, but what you're talking about, I think it's an opportunity there for the franchise because it's very niche. So
Yeah. Well,
yeah,
I was in Japan in October, right? And it's so easy to find healthy food. It's like everywhere. Like the fast and convenient food in Japan is like so much healthier than like sit down $30 lunches here. It's crazy, man.
yeah. I have a theory, and I could be wrong. Maybe it was McDonald's that kind of shifted the whole entire nutritional whatever. But I
I
think
think it's
that's,
just profit motivation, man.
yeah, that's very true.
I think
But it's
that's
affecting it.
that's what it is, man.
Yeah. What do you guys think? Let us know. Put the comments on there. Share your thoughts. Because I'm keep hearing a lot of people like, U.S. food is crappy compared to overseas. So I have to say I agree to that. But yeah.
I agree with that wholeheartedly, brother.
Yeah, yeah, absolutely. All right, awesome. So, guys, you have any questions? You want to dive more in depth about creating wealth or building the knowledge to understand how to invest in alts. Anything that has to do outside of stocks, bonds, and mutual funds. Creating wealth for yourself. It could be real estate, buying a company, or investing in whiskey or investing in oil and gas, like minerals, like the gentleman that we had, Tim, the past episodes. We are launching a membership that is coming on next month, and we're going to be doing workshops. If you are in Texas, in Dallas area, we're going to be having workshops for you guys as part of the membership. We're also going to be having some virtual classes as far as like due diligence, doing a case study on past experience, so you can start knowing what you're getting yourself into. Now, the one thing that I do want to, you know, say again about Beyond Stocks is that we are focusing on helping individuals that don't understand the financial world. But hey, we qualify as an accredited investor, but just don't know where to start. And our point is to help you guys out. We're not trying to be the next, multifamily mastermind group or so. We're just here to help you educate different asset classes that exist. We don't know everything, but we do know the experts. We understand and we know how to ask questions. You know if we don't understand it, we know how to ask these questions so we can better understand it and break it down in the simplest way so it makes sense. Because remember, when things cannot be explained in a simple way, and if it's too confusing, there's no point for me to jump on. You want to add anything to that, Shiro?
Nah, man.
Yeah.
That was a great summary.
Yeah, thank you. Yeah, I appreciate it. So, all right, guys, stay tuned for the next show. And again, any questions? If you haven't done so, go ahead and subscribe to our newsletter so you can be up to date with our, things that we're doing in the DFW. All right, guys, take care. Until next time. Peace.